Well, when you really look at what's happening in the world today with increase in economic activity, increase in inflation expectations, increase in employment as we recover from the pandemic, what we're seeing is kind of how we're positioned, that those companies which are economically sensitive, whether it be the financials, the industrials, consumer discretionary, this is really, in our view, the place to be. Because if you look at things over the medium and long term and compare it to the valuations of these businesses today, these companies sell at 5, 6, 7, 8% free cash flow yields and should be able to grow that free cash at least mid-single digits. And compared to the tech sector, which has these huge market caps, very little of any free cash, kind of infinite valuations, clearly going into an economic recovery, tech is not, at least the tech that is associated with large market caps and low cash flow streams, this type of tech is not where you want to be. You want to be in economic sensitivity. This is where the value is today.
Which country do you want to be in economic sensitivity and value? Because you do run the Oakmark Global Fund.
Yeah, we're very country agnostic, meaning what we really search for underlying businesses that meet our value criteria. What does value mean to us? Looking for low-priced companies that are good quality earning streams, good return structures on their assets and equity, good managements that deploy free cash in a way which generates shareholder value. And when you take a look at these characteristics, certainly the United States from a quality perspective is there, but it might not be there as much from a price perspective. So we're a bit underweight in the U.S., only because we're able to find better value in other places, namely Europe and the United Kingdom, which have really lagged over even the greater part of the decade. And part of it started off as a currency play. As the dollar got stronger, these places became relatively unattractive. But today, we really see this is where there is value. Keep in mind that people often confuse just a European company being part of stagnant Europe, but not realizing that European companies and even UK companies earn their money all over the world. They earn it in the United States, they earn it in the emerging markets, as well as in Europe. And I think this is one of the anomalies that enables a medium and a long-term investor, which kind of describes what an investor is. It's something you could take advantage of. It's a market imperfection. So this is where we're finding the value today.
So you like Europe, David. Are you concerned about the vaccine rollout, meaning that you might get less impressive 2021 returns than you'd initially hoped at the start of the year?
No, not really. This vaccine rollout bumble around what Europe has done. And by the way, this is what happens when you have big bureaucracies that are slow moving. I mean, look at the UK broke off from Europe. And as a result, they were nimble and they approved and had a vaccine rollout. But when you look at a cash flow stream of a business, you're not looking at just the next couple of quarters. You have to consider the next half year, 3 year, 5 year. And when you look under this type of microscope, Europe is going to be just fine in terms of these businesses. Sure, there might be reopening a month or 2 or 3 years later than, say, the UK or the US. And as we know, the US opens up at different speeds depending on the state. But eventually what we're going to see is all this pent-up demand combined with the US stimulus, which, one might even say just dumped a whole bunch of gasoline on a already strong fire. But this is going to help grow not just the US, but the rest of the world. But with reopening of the global economy, you see already the estimates are 5 to 6% GDP growth. It doesn't matter whether it's going to open in April or May or June or March. What's pretty evident is that there is going to be a reopening. The pandemic is starting to slow down, and you're going to see explosive growth. And as such, I believe investors should be looking for where they can find value in those companies that are economically sensitive.
Shepard Smith here. Thanks for watching CNBC on YouTube.